This voice is taken from an article with the title, How to Interpret the Relative Strength Index, RSI, in Cryptocurrency Analysis, which has been published on TRADERTALKSNET. The relative strength index, RSI, is a technical indicator often used in trading analysis and is especially popular when it comes to the analysis of cryptocurrencies. It is a momentum indicator which measures the magnitude of recent price changes to assess whether an asset is overbought or oversold. It is calculated by taking the average of the higher closes over the past 14 days and dividing that by the average of the lower closes over the same period. The resulting value is then expressed as an oscillator that ranges from 0 to 100. The RSI is commonly used to identify overbought and oversold conditions in the crypto currency market. A reading below 30 is considered oversold, suggesting that the asset may be undervalued and may be due for a rebound. On the other hand, a reading above 70 indicates that the asset is overbought and may be due for a pullback. When interpreting the RSI, it is important to note that it is not a prediction tool. It is simply a measure of recent price movements and does not guarantee future performance. As such, it is important to use the RSI in conjunction with other technical indicators and fundamental analysis. Another important thing to keep in mind when interpreting the RSI is that it is a lagging indicator. This means that it only reacts to price changes after they occur rather than predicting them. As such, it is best used to confirm price movements rather than predict them. Finally, it is also important to note that the RSI is a relative measure. This means that the indicator is relative to the price of the asset rather than providing an absolute measure of strength or weakness. As such, it is important to note that a high RSI reading is not necessarily an indication of strong price performance. In conclusion, the Relative Strength Index, RSI, is a useful technical indicator when it comes to cryptocurrency analysis. It can be used to identify overbought and oversold conditions in the market, but it is important to note that it is not a prediction tool and should be used in conjunction with other technical indicators and fundamental analysis. Furthermore, it is important to remember that it is a lagging indicator and that its readings are relative to the price of the asset.